After a forgettable performance in the fourth quarter, technology behemoths are bracing for more uncertainty in the near term, thanks to the banking turmoil and fears of an impending recession in the US. Now, management commentary from both TCS and Infosys painted a grim picture. Growth, margins, and discretionary tech spends are some of the areas of concern. However, while most analysts still have a buy call on both the IT majors, TCS comprehensively beats Infosys on most parameters, even as it commands a higher price multiple. Now, in this video, we compare how the top two technology heavyweights stack up versus each other and which one of the two is worth a bet post their quarterly earnings. But first, don't forget to like and share this video and subscribe to the Moneycontrol YouTube channel. Now, it is mostly a choice between bad and worse. While TCS results missed expectations, Infosys numbers were a punch to the gut. Now, revenues, profit and margin all declined sequentially. Now, this was in stark contrast to the past few quarters when Infosys had managed to outshine the IT sector bellwether. But a bigger jolt came in the form of a cut in FY24 revenue forecast to 4.7% by Infosys. Now, this is markedly lower than the 13 to 15% forecasted for FY23. Now, TCS does not really give guidance, but a deterioration in growth is widely anticipated. But based on the Q4 narrative, Infosys seems to be on a weaker wicket. Shares of TCS and Infosys have seen contrasting fortunes since their results, in tandem with the street commentary. Now, the gap in their YTD performance demonstrates the uphill task confronting Infosys at present. Meanwhile, the verdict on TCS remains largely unchanged even post its muted show in Q4, mainly due to its healthy order book. In fact, the number of buy recommendations have gone up and sell calls have gone down. Infosys, on the other hand, has been hit by a wave of downgrades after posting weak March quarter earnings. The number of buy recommendations on the stock post-earnings fell to 29 from 38, and the number of hold and sell ratings have also come down. IT stocks have seen a correction over the past year, which has brought down their valuation multiples to around their 10-year averages. So TCS trades at a trailing PE of 28.8x, which is a little higher than its 10-year average of 22.58. Thus, it commands a premium to Infosys, which is trading at 22.6x currently, which is just a shade higher than its 10-year average of 19.58x. Now, historically, TCS has always commanded premium valuations vis-a-vis Infosys, though the gap has narrowed over the last few quarters as the Tata Group firm's growth trailed that of Infosys. Now, HDFC Institutional Equities expects Infosys to grow less than TCS in FY24, based on portfolio mix, based on the relative differential between North America and UK portfolio, and the relative weakness and strength in those geographies. Thus, it values Infosys at a 20% discount to TCS valuations. Earlier this year, NASSCOM had noted that there are a lot of storm clouds gathering on the global landscape. Now, the industry body had struck a cautiously optimistic note in the wake of growing risk of a recession and macroeconomic headwinds in the Western world. Now, ICRA's latest projections too underscore the subdued growth expectations for the Indian IT companies in the current fiscal. Now, the domestic rating agency has said that Indian IT revenues will slow down further to mid-single digits amid intensifying headwinds for the nearly $250 billion sector. Well, for more such videos, stay tuned to Moneycontrol.